Hello, good morning to all. Welcome to a brand new day. I'm Kelvin Wong here, the Senior Market Analyst of OANDA Asia Pacific. Very good morning and what a night. All right, given that yesterday we do have a very interesting movement across the various cross asset classes in the global market, ex-post FOMC meeting. So, very good morning. Welcome to a new one. Today will be the 1st of February 2024, Thursday. So, before we jump into today's daily dose of market insights, let's take a look at the disclaimer slides first. All right. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses could exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right. So now, as usual, let us kickstart with what has happened yesterday in terms of the key events. So we know that yesterday is FOMC day. That means U.S. Federal Reserve decision on their monetary policy. So as we know that the U.S. Federal Reserve, the Fed, has been on the mode of tightening interest rate 1.5 years ago. And yesterday they chose to actually stand pat on their key benchmark interest rate, which is the Fed funds rate, at this 5.25% to 5% for the fourth consecutive meeting. But what's interesting over here is that Powell actually not Powell. Okay, let's start with the monetary policy statement first. So the monetary policy statement issued after the decision on the meeting remove the particulars statement that imply that there are going to be further interest rate hike going forward in 2024. So what they actually implied over here is that we have already more or less reached the peak of this interest rate hike cycle, high odds of it at 5.25% to 5.5% for the Fed funds. The next step for it to decide is when will the Fed will be cutting rates and the pace of the cut. So what actually Powell did try to actually massage the, okay, let me share with the screen again. So what Powell did was he tried to actually uh, massage the expectation on the market participants pricing that's inferred to the first rate cut. Initially, it came in March, so that was actually prior to his December very dovish Q&A session during the press conference. So during that point in time, he did mention that he gave pretty much clear signs that there could be a chance that March could a high chance that March is the first rate cut. So at that point in time, you see 70% chance and 80% chance of a pricing odds being inferred by the Fed funds futures market. But it seems to us that the Fed do not want the market to jump ahead of their what I call operational OM in terms of this start of the interest rate cut cycle. So what he did mention over here is that he said that he still did mention this very thing that no cut until officials are more confident on inflation path. So he tried to paint a picture that yes, inflation is slowing down, but he still need more data to be certain that they could be hitting towards that 2% so-called golden standard goal of inflation. So overall, net, he tried to reduce the expectation. Okay, push back the expectation down the road. Okay, so it seems to me that he's trying to massage the expectation. But what's interesting over here is that he also did mention that I think one of the reporters actually quizzed him during the Q&A. It seems that he did actually, perhaps just a slip of his mouth, he mentioned that if the labor market starts to weaken significantly, he will be prepared, the Fed will be prepared very likely to actually start to be more aggressive and in starting to cut their interest rate, the Fed funds rates. So what, based on that particular statement itself, if you look at the CME watch tool, so this for those who actually follow our market daily dose of insight every day, I did mention that one of the website that we could monitor the pricing of Fed funds rate expectation is from this CME. Just Google CME Fed Watch tool. So CME actually came up with a tool. No need to do any calculation. It's being automatically calculated based on the current pricing of the 30-day Fed funds futures. So you look at the March meeting, 20th March meeting, right now, market are still based on the Fed Fund futures. Net conclusion after ex-post FOMC Fed Chair Powell the press conference. Actually, they have a slight uptick from yesterday before FOMC was pricing at 40.4%. So now market is now expecting a slight uptick of 53% chance of the first rate cut to come in March. So that is still live, right? It's not that dead yet, despite the fact that the Fed is trying to initially at the start of the press conference, he tries to push back the expectation of the first Fed fund rate cut. So based on some of the statements, like one of the statements he mentioned to the reporter that he will be ready to cut more aggressively if the US labor market starts to deteriorate. So with that statement itself, the bond market and the FX market actually reacted to this dovish, perhaps I would say maybe it's a slip of a dovish tilt, slip of a tongue. The 10-year US, we call it Treasury yield as an indication of long-term interest rate, okay, because this is a benchmark for long-term borrowing costs. So you look at the 10-year US Treasury yield yesterday, going to inch much lower, and in fact, right, it's already during this mini corrective rebound within its medium-term downtrend that is in place from 23rd of October all the way down to the late December last year. Yesterday's decline was the worst decline in terms of the what I call US 10-year Treasury yield performance since the start of this corrective rally from 27th of December all the way up to 25th of Jan this year. So yesterday it went down to about 12 basis point. Okay, so what we could see over here is that it seems to us that the US 10-year Treasury now is start to resume its bearish impulsive sequence within this medium-term downtrend phase that's still intact from the 23rd of October last year. So the next support level to watch after the break of 27 December low, which is at 3.77, will be 3.60. So given that the 10-year Treasury right now is actually pricing in a very dovish Fed, we call it OM going forward, that actually translate to a weaker dollar as well. So if you look at the dollar performance over here, if I were to share with you all, yeah, this is the 5-day rolling dollar performance. Okay, so what we could see over here is that the dollar actually starts to decline over here. So the most sensitive carrier of them all is the dollar yen. Why? Because dollar yen short-term interest rate is still negative, but right now the dollar is underperforming in the most sensitive carry, which is the yen. So indicating to us, right, dollar weakness seems to be coming back into the picture on the most sensitive part of the carry, which is the yen currency, then thereafter also followed by the Swiss franc as well. But dollar still remain pretty much resilient on the euro and the sterling, and sometimes during the Aussie as well, because Aussie is related to this it's being we call it two conflicting factors is happening Aussie, because Aussie now is also pretty much dependent on the faith of the Chinese economy. So as you know that the Chinese economy right now, there's some structural deflationary risk issue that's still ongoing. So that is actually also capping further pronounced Aussie dollar strength. Okay, so that could actually explain the so-called the more or less the sideways range movement on the Aussie dollar in the last few weeks or so. Now, what's interesting over here, I want to translate over here is that yes, even though the FX market and the Treasury market, US 10-year Treasury yield that I flashed to you a while ago, showing a much more dovish tilt ex-post FOMC, all right, net after all the fireworks that was actually shown yesterday, but that doesn't imply into the stock market. So if you look at the stock market, the US stock market yesterday sold off. Yes, during Fed Powell press conference, they attempt to actually do a recovery, but towards the end, it sold off. Okay, so let me tell you all the stats first. Okay, so the SPX actually fell negative 1.61% yesterday. So yesterday's daily performance is the worst daily performance worst single day daily performance since March last year. The one that is has a higher beta, more we call it concentrated on the growth aspect of the market will be Nasdaq 100, was one of the second worst performer yesterday, negative 1.94%. The Dow Jones Industrial Average fared slightly better, only down negative 0.8%. The Russell 2000 was the worst because this was a small cap company, so considered as a higher growth index, down negative 2.45%. So it seems to us that right now there's a desynchronization of movement in the marketplace yesterday. So to me, it's quite a surprise as well. So if you look at the heat map of the S&P 500, it actually show a series of red, especially the degree of redness concentrated on this so-called mega cap stocks itself. Okay, and one of the reasons I believe that there could be due to also systematic risk resurgence in the US financial sector, because yesterday there was actually a news flow coming out from here that's saying that one of the regional banks is actually facing this problem again as well. All right, this regional bank problem. Okay, so let me share with you where is that particular news flow on that bank, that US bank. Give me a minute. Let me open up the chart again. Okay, yeah, this is the one. Okay, let me share the screen over here. Good. Okay, so it's one of the regional bank called NY Community Bank Corp. Due to it actually made this what I call a very what I call it bearish guardian, saying that its real estate holding, there's a loan loss provision saw on some weakening credit quality on the real estate, on its real estate so-called assets that's being held in on its balance sheet. So that actually also could be one of probably is highly one of the reason that actually causes that we call it throughout that very weak performance, risk off performance seen across the US benchmark stock indices, and as well as also because of this very negative news flow from one of the community bank, now putting that resurgence of that real estate coming back, the balance, so-called US regional bank balance sheet risk resurgence. So that also causes the financial sector in the US to underperform as well in terms of their what I call it stock prices performance as per yesterday. But I would say that it's a bit of conflicting sector right now. We do not see a tightening of the liquidity condition because the US 10-year Treasury yield has starts to tumble. Dollar also starts to get weaker as well from the dollar yen perspective. So it's more like a mixed bag performance rather than potentially the start of a medium term or major term bearish reversal on the stock index as per se. Right, so I cover much ground how to interpret to link up the dots from yesterday's FOMC exposed impact across the various cost asset classes. And what's interesting over here is that gold price actually rallied as well, okay, because due to dollar weakness and as well as the we call it a fall in the US 10-year Treasury yield. So for gold price, actually it went up as close about 1% plus. Okay, later I'll share about the gold chart for you all. So that could also a sign of indication that liquidity is not tightening, okay, given the fact that gold actually has an inverse correlation with US Treasury yield and dollar performance. Very mixed bag picture for WTI crude oil as it continued to trade below 78.40 US dollar per barrel, but didn't manage to break below $74 US dollar per barrel. All right, so later I will touch more on the short-term technical outlook on the WTI crude oil price. So now let us jump straight to the short-term technical outlook, since we already covered the linking the dots across the cross asset classes due to the impact of exposed FOMC. So let us start with the FX market first. All right, so on the FX market, right, if you look at the FX market over here, let us start with the let me have a quick overview on the dollar index first. All right, so the dollar index is a composite of index, okay, across the major currency put away. So it started to trade sideways, sideways over here. This is the dollar index. So the dollar index, yes, it rallied from end of December until the middle of Jan. So the middle of Jan, it can't break above the 200-day moving average and started to trade a series of what I call doji-like or long-legged doji-like candle, very small body candlestick, a lot of indecisiveness in the last two and a half weeks, all right, over here. But some of the pair has started to actually strengthen against the dollar. So let us start with the euro dollar first. Okay, so for the euro dollar currency over here, let me expand my screen and as well as so that you guys see much clearer. Okay, this is euro dollar. So we can see that this euro dollar yesterday it actually plummeted below the 200-day moving average. All right, so the dollar index was above the 200-day moving average, but the euro dollar ex-post FMC managed to reintegrate back below the 200-day moving average. So indicating to us that the euro is one of the weaker currency within the universe of currency. So with that over here, right, it seems to us that the euro dollar at this point in time is also trading below the 50-day and the 200-day moving average. So in the last session since last Friday, right, it attempted to break above the 200-day moving average since last week, since earlier last week, but can't break above it and starts to form a series of lower higher. Okay, yesterday's similar high, but where it reacted over here is that it reacted right at this minor descending channel resistance that I drew from the high of 11 of Jan. Then thereafter it plunged below the 200-day moving average and also right below the downward sloping 20-day moving average as well. So based on the price action that was being depicted by the euro dollar yesterday, it seems to us that the bears in the short term are still has more we call it power versus the bulls at this point in time, at least in the short term. So short term, in my some of you ask what is short term in my horizon. So short term in my technical analysis horizon is where I'm talking about 1 to 3 days perspective. Okay, so based on the euro dollar we call it emergence of this short term bearish element, I'll be flipping to a bearish bias in the short term, uh, as long as it didn't surpass above 1.0890 short-term pivotal resistance highlight today, a breakdown below this near-term support that is in place since 30th of Jan, which is this Tuesday at 1.0795, potentially sees the next support coming in at 1.0740. So this could be a potential inflection zone where we could start to see a much more substantial recovery. Why? Because it's actually the lower limit of this channel, this descending channel, could be the potential bearish exhaustion point, as well as the one-time Fibo projection taking from the high of 20th of December, push it down from the low of 5th Jan, project it from 11th of Jan, 1.074, also confluence with the former we call it the current minor swing low area of 9 of earlier December last year, and as well as close to the 50% 61.8 Fibo retracement of that previous up move from 4th of October to 28th of December. So this 1.0740 support level is considered as a key inflection zone for a potential recovery. Okay, but we are taking one step at a time. If since haven't hit this level yet, short-term technical elements are weak, so we'll be using 1.0890 short-term pivotal resistance, break below 1.0795, expose the key inflection level, support level at 1.0740. So for now, we will flip to a short-term bearish bias. So for sure, only an hourly close above 1.0890 will invalidate this short-term bearish bias to see the recovery towards 1.0965, followed by 110 figure level, resistance level in the first step. Sterling dollar. So on the sterling dollar, later I'll share with you there could be a key event taking shape today that impacting on the sterling dollar, which is the BOE, Bank of England interest rate decision. Later we'll talk more about that towards the end of today's daily dose. All right. So for now, for sure, it continue to churn between 1.2760 and 1.2640. So the churning over here seems to be still evolving. Price action still evolving within this minor symmetrical triangle range configuration that is in place since the high of 28th of December last year. So given very unclear technical elements and it's going to trade sideways, so we will be still maintain that sideways neutrality range bias between 1.2760 and 1.2640 for now. Okay, unless we start to see a clear breakout between these two range, that means a breakdown below 1.2640, see that at least the start of a minor corrective decline towards 126 figure and 12550. If not, there's a high chance that it could still trade within this range for now in the short term basis. So maintain that neutrality sideways range bias in the short term on the sterling dollar. That means that's GBP / USD between 1.2760 and 1.2640. Okay, moving on next to the Asia Pac currency, Aussie dollar. So Aussie dollar no change, still Okay, yeah, still continue to churn within a sideways range. So yesterday exposed FOMC, it came down 65.60, managed to see some bits coming in again to support it at 65.60 level. So with that, what we could see over here is that the RSI has started to slope a higher low over here, the hourly RSI. So indicating to us that there is still some short-term bullish bias, that is still short-term bullish momentum that is still supporting the Aussie dollar. But on the top side, it got to break above 66.20 for sure. That is acting as a near-term range resistance since last Wednesday. So all in all, no change for sure. 65.60 short-term pivotal support, maintain that bullish bias within this minor range configuration. Resistance level towards 66.20. Only an hourly close above 66.20 will see a much more pronounced rebound towards 65, 66.50. Perhaps thereafter 66.50, we should see 67 figure level. All right. Only an hourly close below 65.60 will see another slide to test 65.20, which is the swing low area of 17th of Jan. And as well as if you zoom out from the daily chart over here, you see that 65.20 is a key medium term pivotal support because it was a clear congestion zone since 4th of August. Previously resistance break tested, turns into a pullback support. Okay, so net overall still maintaining that short-term bullish bias within a range configuration on the Aussie dollar as long as 65.60 pivotal support holds. First resistance 66.20 for sure. Dollar yen, like I mentioned at my start of my daily dose, is one of the currency that is actually showing pronounced dollar weakness. That means we're talking about yen strength, and don't forget that the yen is a very sensitive carry trade, so that could actually represent ongoing dollar weakness as well. So what you could see that the dollar yen yesterday continued to tumble, even way before the FOMC announcement. It tumbled, then thereafter Powell press conference, it tend to recover, and right now it's trying to trade back below the 20-day moving average again. So bear in mind, for those who first joining us, this trading view, yes, this is the hourly dollar yen chart, but in trading view, we could actually plot a higher time frame technical element like what I did over here, the 20-day MA. So this is not a 20 period hourly MA, it's a 20-day MA plotted on the same chart on the hourly dollar yen. So I could do multi time frame technical analysis on a single chart, save my time from switching my chart to and fro between daily and hourly. So I could see over here is that momentum has started to turn weak again after the reintegration back below the 20-day moving average exposed FOMC press conference from Powell. So all in all, you could see that we start to see a series of lower high as well since the minor swing high of 24th of Jan. So with that new technical element that is on the bearish side taking shape on the dollar yen, we could I will actually tidy up in terms of a risk reward perspective. Yes, yesterday it also hit the support level and bounce. So that still recall that we will have that bearish bias since last week. First support to watch 46.25 has already been met. Now rebound, but the way it rebound is kind of very lackluster. So we still maintain that bearish bias on the dollar yen with a tightened key short-term pivotal resistance for today at 148 figure level. So what's 148 figure? It confluence with two different elements pointing at the same level. Minor swing high yesterday that was tested as well before the sell-off, and also right now the minor descending trend line at 20 linking from the high of 24th of Jan and 29th of Jan, all confluencing at 148 figure level. So as long as 148 figure level didn't surpass to the upside, we will still maintain that short-term bearish bias on the dollar yen, with the next support level to watch will be now at 144.55, confluencing with the 200-day moving average and the congestion area of 8th of Jan and 13th of Jan. Only an hourly close above 148 will negate this bearish tone, pardon me, to see a retest of that minor range top at 149.80. Okay, so net still maintain that short-term bearish bias on the dollar yen with a tightened key short-term pivotal resistance for today at 148 figure level. Now, this thing will get a bit more complex right now, will be the stock indices. So stock indices is right now very mixed across the board in the short-term perspective. So let us start with the Asia side of the story first for the major stock indices. Let me highlight to you where is the stock index. All right. So let us start with Hang Seng. So for Hong Kong 33, right, it continued to be below the 15,900 pivotal resistance that we highlighted yesterday, also right below the downward sloping 20-day moving average. So as long as this 20-day pivotal 20-day moving average, which confluence with this 15,900 short-term pivotal resistance is not surpassed to the upside, we will still maintain that short-term bearish bias on the Hong Kong 33 index, which is the Hang Seng index. So the near-term support level to watch will be at this 15,400, which was yesterday's a minor swing low that was that has been formed and managed to help in yesterday's US session and as well as today intraday Asia session. Okay, so this was the first support. A break below 15,400 exposes next support, which is also the psychological level at 15,000. Only an hourly close above 15,900 will see another round of potential corrective rebound, minor corrective rebound sequence within its medium term downtrend, with the next resistance to watch will be at 16,220 slash 16,525, which confirms with the 50-day downward sloping moving average as well. So overall, net still maintain that short-term bearish bias on the Hong Kong 33 index as long as 15,900 short-term pivotal resistance is not surpassed to the upside. Okay, Japan 225, Nikkei 225. So Nikkei 225, yesterday, prior to the FOMC meeting, it intend to shape a push up with our expectation, almost hit the resistance at 36,540 before selling off throughout the US session yesterday. And right now it's intend to do a recovery by shaping a higher low right exactly at this upward sloping 20-day moving average, now acting as a support at 35,745. So I don't want to put it so tight, 37,545 as my short-term pivotal support level, still using a slight below one, which is the minor swing low of 17th of Jan at 35,350. And also if you do the 35,350, is also the 38% Fibo retracement of the last impulsive up move from a low of 4th Jan to 23rd of Jan. This 38.2% Fibo retracement. All right. So with that, as long as 35,350 short-term pivotal support holds on the Japan 225, pardon me, we will still maintain that short-term bullish bias. First resistance to watch for sure will be at 36,540, then thereafter followed by 37,000 psychological level. Only an hourly close below 35,350 will see the extension of this minor corrective decline to retest the next support level at 34,840, which is the 50% Fibo retracement level, and sooner or later it could be coming very close to this upward sloping 50-day moving average as well. Now, German 30, which is the proxy as for the European indices. So for German 30, right, it's kind of weak yesterday. So yesterday, price actually managed to broke down below this minor ascending channel from the low of 19th of Jan, and right now perhaps right it could be shaping this minor corrective decline within its short and medium term uptrend. Why short and medium uptrend still intact? Because price action is still trading above the 20 and the 50-day moving average. So net what I could do over here is that I will use yesterday's pullback resistance of this former minor ascending channel support at 16,970. So as long as any we call it a bounce didn't surpass 16,970, potentially this minor corrective decline could actually extend to test the next support level, the near-term support level at 16,710, which is the 20-day moving average, slash 16,620, the lower limit, which is confluencing at this, I think 61.8 Fibo retracement of this last push up. Yeah, 61.8 Fibo retracement of this last impulsive up move from the low of 17th of Jan to 30th of Jan. All right, confluencing at 16,620. So net overall, given the deterioration of short-term technical elements on the German 30, but however, the medium-term uptrend and the short-term uptrend is still pretty much intact. So what I could do over here is that it's actually doing a retracement, or I'll put it away that it's a minor corrective decline. As long as 16,970 is not surpassed to the upside. So we're flipping to this potential, to this bearish bias to see this potential minor corrective decline scenario unfold as long as this 16,970 short-term pivotal resistance is not surpassed to the upside, with the support level to watch at 16,710 followed by 16,620. However, only an hourly close above 16,970 will invalidate this minor corrective decline sequence within its short and medium term uptrend to resume the impulsive up move to test the next resistance at 17,130/17,155. Okay, so now US stock indices. So US stock indices, the one that is still holding the fort will be the not holding the fort. It didn't actually have a proper break or that short-term pivotal support that we highlighted, 38,200. So what I did over here, that it came down, and right now during the Asia session, it managed to attempt to recover again. So it seemed to us that over here there's this minor congestion area where you could see former range resistance, break now turns into a pullback support. So we will be having a bit of so-called access on the downside for yesterday's push down during Expo's Powell press conference or Expo's FOMC. So using 38,200 slash 38,080 as my short-term pivotal support level. So as well as 38,080 didn't surpass to the downside, we will maintain that bullish bias on the US Wall Street 30. The first resistance to watch for today will be only at 38,400. So 38,400 is considered as the breakaway line where the price actually broke here, broke the 8,400. Then before that, steep intraday sell-off took place yesterday. So what you could see over here, this long black hourly candle. So the top of the long black hourly candle is at 38,400. So it's something like a breakaway support now turns into a pullback resistance. Okay, so as long as 38,080 short-term pivotal support holds the access, potentially we will still maintain that bullish bias in the short term. First resistance to watch will be 38,400. Okay, only an hourly close below 38,080 will see an extension of this ongoing minor corrective decline within its short and medium term uptrend phase that is still intact to test the minor swing low area of 25th of Jan at confluencing also with the 20-day moving average, and also confluencing with the former range top resistance from 29th of December to 12th of Jan, now acting as the same level as a pullback support at 37,800. Okay, Nasdaq. So Nasdaq yesterday, yes, it was one of the worst performer among the major stock indices yesterday, other than the Russell 2000. So the way it's slide over here, it actually come close to the 20-day moving average as well. Okay, and what you could see over here, interestingly, right, the hourly RSI, this is the hourly RSI, starts to shape higher low. Okay, while price action shape lower low as it deep down towards the 20-day moving average. So what I could see over here is that it means that yesterday's sell-off is a bit overextended, but it's not being reflected in the momentum indicator, which is the hourly RSI. So RSI showing higher low. So it need to us that this downside momentum may have started to ease off yesterday, at least in the short term, right at the 20-day moving average that is acting as a support at 17,060. So at the bottom of 17,060, that was the alternative scenario where price broke below the support level. So yesterday we do have a very tight support level at around 17,380, 17,400 or so, that 7,380 mark. So price broke below 17,340, but I broke below it and almost come close to this support level that I highlighted at 17,060. So I would say that the alternative bearish scenarios more or less has already been met, given yesterday push down, and also the positive element that has been seen in the RSI. So with that, we could actually maintain that bullish bias because it's almost coming close to the support level that we highlighted in the alternative scenario. That means if the support level breaks. All right. So and also, but I don't want to put it so tight, right? So today's short-term pivotal support, I will use the 16,910 level. So what is 16,910, right? Just slightly below it is the lower boundary of this minor ascending channel. All right, and also the former minor range resistance from 11th of Jan to 18th of Jan now turns into a pullback support level. Okay, turns into a pullback support level. Okay, so as long as 16,910 short-term pivotal support holds over here, will be still maintaining that bullish bias for a recovery. So first resistance to watch will be at 17,360 for now. All right. However, if we start to see an hourly close below 16,910, then this minor corrective decline will start to extend to test the 50-day moving average over here, which is also confluencing at this support area, this minor swing low over here at 16,570, which is the minor swing low of 17th of Jan. All right. So with that, using 16,910 as a short-term pivotal support level over here, potentially looking out for a recovery, short-term recovery on the Nasdaq 100 with the first resistance to watch at 17,360 for now. Okay, then now moving on, next will be gold, spot gold. So spot gold yesterday, right? If you look at the spot gold, okay, but spot gold, give me a minute. Yeah, this spot gold. So spot gold, what we see yesterday, if you go to the daily chart of spot gold, it did a very okay, so today Asia session it did a recovery. So yesterday was kind of sideways as well, a positive 0.11. But now, right now during the Asia session, exposed FOMC meeting, it start to shape continue to shape a series of higher high, higher, low, and now it's the 20-day moving average. It's clear go over 20-day moving average. So with that, right, I'll be because price action really tested one time, two time yesterday, and higher. So what I could do over here is that given the test of twice time, so from a better money management or risk reward management perspective, and also the RSI also managed to bounce off from this key pullback support level as well at the 40 level mark, and now going above the 50 level, indicate to us that it seems to us that the momentum seems to be pretty firm on the positive bullish side of the story. So with that, I'll be using 2029 instead for today, a Titan level. Okay, let me remove this. Okay, 2029 as my Titan key short-term pivotal support for today, which is also conversing with the 20-day moving average. So as long as 2029 short-term pivotal support holds for today, potentially we still maintain that bullish bias. For the first resistance to watch will be at 2060. Above 2060, we'll start to see a more pronounced minor bullish breakout to test the next resistance at 2090, which is the 28th of December minor swing high area. Only an hourly close below 2029 will negate this bullish tone to see an round of a choppy movement to retest this 2015 support level, which is also conversing with the minor ascending trend line. Okay, around the minor ascending trend line that I drew from here, from the low of 18th of Jan. Okay, so net, we will still maintain that bullish bias on Gold XAU/USD with a Titan key short-term pivotal support for today, given the emergence of more positive short-term elements at 2029, with the first resistance to watch 2060 followed by 2090. Now, lastly will be West Texas Oil. So West Texas Oil going to trade lower, hit the first support level 75/75/7530, and going to see a series of lower high below the 200-day moving average over here. So for sure, 78.40 will be the short-term pivotal resistance, no change. Still maintain that short-term bearish bias to retrace that previous upswing move from 3rd of Jan to this Monday swing high. So a break below 75.30 will expose the next support to come in at 73.90, which confluence with the 20 and the 50-day moving average. And this 73.90 is also the pullback support now of that former medium-term descending trend line that I drew from the high of 28th of September last year. Only an hourly close above 78.40 will invalidate this short-term bearish bias retracement scenario to kickstart another round of potential recovery for West Texas Oil for the next resistance to come in at 79.75 in the first step. Okay, so net overall still maintain that short-term bearish bias retracement scenario for West Texas Oil as long as 78.40 short-term pivotal resistance is not surpassed to the upside. Okay, I covered much ground already, so today is a bit long because I need to share with you all what took shape yesterday, which is very important, and the impact on the cross asset classes. So before we go, right, there's some important data to take note of for today that could actually impact the cross asset classes price movement in a much more volatile way. Also will be, like I mentioned earlier on, at somewhere in the middle, today will be BOE, Bank of England announcement. So Bank of England announcement will come in at 8 p.m. Singapore time. So market is expecting no change at 5.25%, which is a pretty high rate. But what's interesting over here is market is looking for the guidance, because the look among the current central bank right now, major central bank, I would say Bank of England is still the most hawkish. Why? Because in the previous meeting in December, there's actually 3 members within the committee that are still voting for an interest rate hike. not stampede, interest rate hike. So we got to see how the voting scenario goes. But you look at it previously, out of 9, right, there is actually 3 of them hiking. Okay, so market right now is actually looking for only one of them choose to hike, and we got to see whether is there any one of them start to actually vote for a potential interest rate cut, because based on the short-term gilt, the UK benchmark interest rate, short-term interest rate, they are pricing in as the first interest rate cut to come in around May this year. So we see how the guardians unfold, and also at this point in time, Bank of England also released their latest projection for inflationary growth in UK as well. So something to look out for. And also later part of the session at 9:45, we do have ECB President Lagarde public speech again as well. And during the US session, we have the release of that ISM manufacturing PMI at 11 p.m. Singapore time. And also very important to the stock market indexes will be the earnings announcement. So the earnings announcement especially could impact the Nasdaq 100. Okay, let me share where's the earnings here, over here. So we have the remaining mega 7 cap stock, which is the US big tech stock. So at the close of the US session today, that means after 4 a.m. Singapore time, you will see the release of, okay, where is it? Okay, today Wednesday. The release of Apple, Amazon, and Meta right after the close of the US session today. So something to take note of as well. Okay, so with that, thank you for your time, and we shall speak again tomorrow, and have a great day ahead. Thank you.